You're doing your taxes, scrolling through the forms, and then you see it. The word penalty. And, your stomach just drops. But what if I told you that one of those penalties isn't something you pay, but something that actually pays you back? Yeah, let's get into it.
I mean, look at this. This is a real question from a taxpayer, and it just perfectly captures that feeling, right? That sense of dread when a number shows up and you think, what did I do wrong? How much is this going to cost me? It's a totally normal reaction, but in this case, the answer is some surprisingly good news.
And that's really the big twist here. This is not a penalty you pay to the government. Nope. This is actually a deduction you get to take. It's a way to lower your tax bill. Think of it as the one penalty that's on your side. And we're going to break down exactly how this good guy works. Okay, so to wrap our heads around this, we first have to understand that we're talking about two completely different kinds of penalties. One is basically a fee from your bank for breaking a contract. The other, well, that's a genuine punishment from the IRS, and they could not be more different. Here's the side-by-side. On the left, you've got the good penalty. This is usually what happens when you cash out a certificate of deposit, or a CD, a little too early. The bank charges you a contractual fee, and the tax code lets you write that off as a loss. It's a deduction. Now, the penalty on the right is the bad one from the IRS, like if you pull money from an IRA too soon. That's a true tax penalty. So one lowers your taxable income, the other jacks up your tax bill. So how does this helpful little deduction actually find its way onto your tax return? Well, it's not magic, it's just a simple paper trail. It starts with a form your bank sends you and ends on one specific line on your tax forms. Let's follow the breadcrumbs. It's really just a three-step dance. First, you get a Form 1099 INT in the mail. Now, this next part is absolutely critical. You have to report all the interest the bank paid you as income. That's the number in box 1. Then, in a totally separate step, you take the penalty amount from box 2 and you list it as a deduction. You cannot just subtract one from the other before you report it. And this is where you'll find that all-important number. On the super common 1099 INT form, it's sitting right there in box 2, plain as day. If you have a different kind of investment and you get a Form 1099 OID, it's the same idea, just over in box 3. This piece of paper is your source of truth. From there, that number from your bank form has a very specific home on your tax return. For the last few years, it goes on Schedule 1 of your Form 1040, specifically on line 18. It's even helpfully labeled Penalty on Early Withdrawal of Savings. It's really just a matter of copying the number from one box and pasting it into another. Okay, so a question that comes up all the time is, wait, if I earned $100 in interest but paid a $20 penalty, why can't I just tell the IRS I made $80? I mean, it seems logical, right? But tax law says no, and it's because of a really core principle called the Doctrine of Constructive Receipts. All right, so here's how the IRS sees it. The instant the bank credits that full $100 of interest to your account, it is legally your income. It doesn't matter that they immediately snatch $20 back as a penalty. For that one split second, the whole amount was yours. And because of that, you have to report the whole amount as income first. This is what the pros call the gross-up rule. The law basically unbundles that single transaction at the bank into two completely separate events for tax purposes. Event number 1, an income event, where you received the gross interest. Event number 2, a loss event, where you paid that contractual penalty. And you have to report both of these events separately. No shortcuts. Now we get to the really good part. This is why this deduction is so awesome. It's not just that you get a deduction, it's where on the tax form it lives. Its location gives it a special kind of power that benefits almost every single taxpayer out there.
See, this is what's known as an above-the-line deduction. On your tax return, there's a super important number called your adjusted gross income, or AGI. This deduction reduces your AGI directly, and that is a huge deal because that AGI number is the key that unlocks all sorts of other tax credits and deductions. A lower AGI can be a very, very good thing.
And this is really what makes it so powerful. Most tax deductions, like for mortgage interest or state taxes, only help you if you itemize. But since the standard deduction got so high, something like 90% of people don't itemize anymore. And above-the-line deduction, though, it's different. You get to take it whether you itemize or not. That means pretty much everyone gets to benefit from it. All right, I need everyone to lean in for this next part, because this is probably the most common and most expensive mistake people make. The helpful bank penalty deduction is not, I repeat, not the same thing as that painful 10% extra tax you get hit with for pulling money out of a retirement account like an IRA early.
This chart lays it all out in black and white. The bank penalty is just a fee and it gives you a deduction. That's good. The retirement penalty is a punitive tax and it adds to your tax bill. That's bad. They come from different forms, a 1099 INT versus a 1099-R, and they go on completely different schedules. Mixing these two up is a critical, costly error.
And hey, don't just take my word for it. Here it is, straight from the horse's mouth. The IRS themselves explicitly state that the 10% retirement plan tax does not qualify for this deduction. So, yeah, case closed. So, with all the talk about tax laws changing all the time, you might be wondering if this deduction is going to stick around. Well, the good news is this is one of the most stable, rock-solid features of the entire individual tax code.
Just look at its journey. Even after that massive tax overhaul back in 2018, the deduction itself never disappeared. It just moved. It hopped from the main 1040 form to line 30 on the new Schedule 1, then it went to 17, and now it seems to have found a stable home on line 18. The address has changed a few times, but the deduction has always been there.
And get this, looking ahead, the IRS has already put out draft forms for 2025. And even with some new forms being proposed, like a Schedule 1-A, our good guy penalty deduction, it's scheduled to stay put, right on Schedule 1, line 18. It's a reliable part of the tax landscape.
All right, so let's just nail down the key takeaways. 1. That penalty for cashing in a CD early is actually a helpful tax deduction. 2. You have to report all your interest income first, then take the deductions separately. 3. It's an above-the-line deduction, which means pretty much everybody gets to use it. And 4, the big one. Do not, under any circumstances, confuse it with the 10% tax on early retirement withdrawal. So we just took a scary-sounding financial term and completely flipped it on its head. It just goes to show you that sometimes understanding the why behind the numbers changes everything. So I'll leave you with this question. Now that you know a penalty isn't always what it seems, what other financial fees in your life might be totally misunderstood? What else deserves a second look?